Morning, everyone. Waiting for everyone to take a couple of minutes to join us for this morning's session. So if you'd like to sit back and relax, we'll get going shortly. So good morning, everybody. Welcome to our September edition of our Resell Hot Topics. This morning, we're going to take a slightly different angle and replay some of the conversation that we had back in January. And I'm delighted that we're joined by Dean from UBS to help us just think about the economic landscape, particularly as we move forward into our golden quarter, but really thinking about what's the consumer really thinking about how they spend through the latter parts of 23 and going into 24. So let's get started this morning. So Caroline, if you can take me to the first of our slides and the next one. And the next one, please. So I have the delight this morning of taking you through our high street sales tracker. For anyone that's new for us this morning, this has been something that we've done for over 10 years, where we look to track footfall both online and offline. And we've had some interesting discussions around this over the last 12 months. And again, interestingly, as we come out of the summer, and certainly the weather is telling us that summer has come to an end in some ways, it's interesting to reflect on the last 6 months to August. And what you can see is that trading actually has been fairly benign at around 5% if you take a natural curve across all of those lines. If we look at that on a weekly basis, there's definitely been some ebbs and flows that I'm sure everyone in the audience has felt as we've traded through some of those weeks. And uncertainty has been a massive theme that we have seen. It's been very difficult for people to have that confidence if they've gone week to week and month to month and seen an absolute variance in footfall coming. So going from a fairly stable to, if we look at that point in July, that real peak. And if we try and unpick that too much, there is not a lot that tells us why we've had some of these weekly peaks and troughs. If we go to the next slide, it only plays out to what has been a fairly stable year. If we look across the board of our 4 categories there, you'll see for August that most of the categories sat between 4.4 and 4.9%. And actually, if we look at fashion, for example, it's probably traded a lot better than the headlines would have perceived people to think. Now, when we look at these data points, it's quite interesting because we stand back and we say that 23 is on the backdrop of what was quite a benign 22. But interestingly, it was benign because 21 was so good for so many of our clients and contributors to the high street sales tracker. One of the things that we're trying to take away to look at is actually, if we look at the curve from 2019 now through to the majority of 23, what does that normalized curve look like? Because certainly over this last 12 months, if you were to take an average, we've grown by about 5% across the board, which on the backdrop of perhaps some of the headlines that have said consumer confidence is down and that it's been a lot more challenging than we expected, from a reflective point of view, it's not been that bad. And I think those are some of the things that we're going to certainly look to explore further. But going to those headlines and some of this uncertainty where we blend what is the data points that we see here to the headlines and the media speculation of what could happen, may happen. I think it's quite interesting when you take a snapshot of just what's been in the headlines over the last couple of weeks. So if we go to the next slide, Caroline, I think the confidence that we're seeing come back into retail is certainly starting to come through. One of the most surprising headlines for me over the last couple of years, couple of weeks, has been that if we look at retail as a store estate, there's certainly a lot more optimism than perhaps we had when we sat there in January 2023 looking out to the year. At occupancy rates for British land at 99%, I think it's quite an interesting and stark reality that people have certainly moved back to an omnichannel way of shopping. And we've seen that absolutely when we look at the store and non-store like-for-likes. So, for example, August store like-for-likes were 9.4% positive and non-store 2.8%. So that blended model is becoming more and more relevant to retail again, which is a great thing to see as we look to our high streets. And we'll look at some of the cases like Wilko as we go through this morning's session. We've had a late summer. I think everyone has enjoyed the last bit of September sunshine, although it's apparently due to come back to hit us next week. And that has had a real impact. The interesting thing over the other two headlines that we see here is that there's winners and losers. It's definitely not positive out there for everybody. And while some are winning, some are definitely losing. And I think that's going to be a common theme. And all of the headlines that we're seeing are pushing to the fact that those that have gained in market share have done so on the back of really being quite aggressive on how they get their customers to shop with them. And so while volumes potentially are down, price increases are still going up, but people are really thinking about how they attract that customer to come back in. So again, if we move to the next slide, that still plays through it. Fashion, as we said, if we look at our like-for-likes over the last 12 months, I think fashion can stand out as the surprising factor as to how well it's done. But if we look at the headlines around H&M over the last couple of weeks, I think it's interesting that there still is definitely a divide between where people are spending and perhaps some of where people are feeling the pinch a little bit more than others. But the interesting thing is that the headlines aren't going to go away. So whilst we've had some real positive headlines, we're definitely feeling that consumer sentiment is stronger than we expected. There are also things that feel like that we're not quite on the other side of some of the challenges that we've faced. And the final headline that I put out this morning, it is a really interesting one because as of an hour ago, it's a completely different headline. It was one that was a lot more doom and gloom around where inflation was going to sit, that whilst people were surprised that it was coming down, that they expected that we still would have some inflationary pressures and that interest rates were definitely going to go up today. And within 24 hours, the headlines have completely flipped to something that's a lot more optimistic. So I personally am slightly excited, but maybe prematurely, that it feels perhaps that we might have a little bit more stability into the market. We're going to think about that as we go through and do our January trading update. But with that, I have the delight, as I mentioned, to introduce Dean, who's going to join us from UBS, who is definitely better placed than I am to take us through some of that final headline and maybe shed some light on what is to come over the next 12 months. Thanks, Dean.
Thank you. Good morning, everyone, and thanks for inviting me to speak here today. So look, what I'm going to do over the next 10 minutes or so is just discuss the outlook for the UK at a broad macro level and probably touch on some of the themes that could affect the outlook for the retail sector. Now, before I look forward, I always find it's useful to look backwards, just because that gives us a bit of a clue as to where the economy is heading. If I look back over the last year, I think the biggest takeaway has been that although the economy economic performance hasn't been that strong for all intents and purposes, the economy has essentially just moved sideways for the past for the past year. The outcome has certainly been a lot better than was feared perhaps this time last year. If you think back to last September, the only question on anyone's mind was not if there was going to be a recession, it was how deep would that recession be. But we avoided that recession for a number of reasons. What happens with gas prices and a fair degree of fiscal stimulus helped us there as well. But think about what the consequence of that has been in terms of a more resilient economy. It's meant that inflation has been more persistent than what many economists had predicted at the start of last year. A recession should have seen inflation fall faster. The fact we avoided that means that price rises have been a little bit stickier, and that's resulted in the fact that interest rates are at levels that we haven't seen for quite a couple of decades. The key question, I know I'm going to get asked this, so I'll address it now. What happens this afternoon? The key answer there is basically it's the toss of a coin. As Laura pointed out, at 6:59 yesterday morning, there was a 90% expectation, 90% probability that the Bank of England would hike this afternoon. By the time we got to 7:05 yesterday morning, after that inflation data release, that probability had fallen to roughly 50-50. For what it's worth, I think the Bank of England will actually hike today. It's interesting that we've already had 3 central bank meetings this morning. 2 have decided to hike following the ECB last week, and one decided to pause, which was following the Fed last night. So I wouldn't place too much certainty on any outcome right now. But I think the balance probably is that the Bank of England does hike rates. But I think that kind of debate distracts from the outlook for interest rates. It's not. To be clear, whether interest rates in the UK peak at 5.25 or 5.5%, it isn't going to make a great deal of difference to the outlook for the economy or consumers, for that matter. The fact of the matter is that the price that consumers or households are paying on their debt today is a function of money market rates that we're expecting rates would go much higher anyway. So irrespective of what the Bank of England does today, I would expect that the consumer should see some relief, at least in the short term, in terms of borrowing costs. But I think it kind of the point I want to say in kind of why this focus on what will the bank do or won't do today distract from the conversation is because the narrative has now moved on. Investors are not really focusing on where the peak level is, where there or thereabouts. The key message that's coming from all central banks, the ECB last week, the Federal Reserve last night, the central banks that have released this morning, and what I expect to hear from the Bank of England this afternoon, is that this high level of interest rates that we currently have are likely to be with us for some time, and we should certainly have in our minds that interest rates in the UK north of 5% are a very real prospect way into early next summer. Now, why that matters is because monetary policy will clearly affect how the economy performs. As I alluded to earlier, the economy has essentially moved sideways over the last 9 months. My best prediction is that we should probably be expecting something similar over the next 9 to 12 months. And there's a couple of reasons for that. The first is that, as I've mentioned, high interest rates are here to stay for a while, and that will have a dampening effect on economic activity. We shouldn't be surprised by that. It's what monetary policy is designed to do. So, it's a good thing that monetary policy is actually working. But we need to bear in mind that high interest rates will act as a dampener on economic activity. I think the other thing that's going to act as a bit of a dampener on the economy will be the fiscal side. Again, as I mentioned earlier, one of the things that helped the economy a lot, especially at the start of the year, was quite a large fiscal stimulus in the form of support for energy bills. We're very unlikely to see a similar fiscal stimulus anytime soon. Lots of talks around will the Chancellor do a pre-election tax cut. He may do. This morning's public sector borrowing figures were again pretty favourable to him. But if that does come, I would expect that's something we have to wait for until the spring of next year. It's not not going to happen in the autumn statement in the next few weeks or so. So again, if there is any fiscal stimulus or any fiscal support, it's something that we're probably going to have to be looking for in the latter half of the year. But it's not all bad news, because if it was just bad news, then perhaps the outlook would be worse. We would be looking for a recession, and that's not our base case. The positives that we've got to look forward to is that inflation is falling. That is helping cost pressures for households, especially against a backdrop where we have a reasonably robust labour market. There's been a few data points of late suggesting that some weakness is creeping in. That's a good thing. Again, I say that's a good thing. It's a good thing from a macroeconomist perspective. The reason for that is that it means that long-term inflation pressures are starting to subside. But against that backdrop of moderately weaker labour markets, we are seeing that that hiring is still relatively strong. We are still seeing positive wage growth. I don't expect wage growth to continue at the levels that have been reported of late, this kind of 7 to 8% range. But we can definitely see a situation next year where real income growth increasingly turns more positive as we go through the year. And look, other things being equal, if real incomes are growing, that should be a benefit to the consumer, and that will offset some of the pressures that we're seeing from this kind of higher interest rate, less generous fiscal backdrop. So how the two interact gets us to the view that the economy is essentially in for a period of what we call sub-trend growth, kind of flatlining, which is what we've experienced over the last 9 months. Now, in terms of probably what it means a bit more for the retail sector and households. I mean, it was interesting just looking at some of the charts that Laura was showing earlier in terms of how resilient the sector has been. And I think, most economists have been surprised by some of the data there as well. But one of the things that is interesting within the data is that, consumers are being much more price conscious in this environment. So whilst we're seeing that volumes of retail sales, excuse me, the lights are going out, they're back on again. Whilst we're seeing that the volume of retail sales is holding up relatively well, when we're actually looking at what's happening in real terms, we're actually seeing that there's quite a big gap opening up, and if anything, real retail volumes are actually falling. Now, what that's telling us is that the consumer's being a bit more price conscious. That's been the trend this year, and if we think about this environment that we're likely to be heading into over the next 9 months, where we still have higher interest rates, the cost of borrowing for households is still relatively high compared to the last cycle. We should expect that those trends do continue. It's not it's not a picture I want to leave you with that it's one of a very negative one. The consumer will still spend, and one of the reasons for that is the labour market, because notwithstanding all of the macroeconomic themes or press stories that we read, the biggest determinant in terms of consumer spending is, does the consumer have a job, and do they fear losing their job? And in the current labour market, and a labour market that we expect to remain reasonably tight, neither of those factors are likely to come into play over the next 9 months or so. So, we're expecting that things can hold up, but perhaps we'll have to wait a bit longer until we get to much sharper recovery. And that leads me on to kind of when we be thinking about when that recovery can come. I think it's unlikely that we get a catalyst for a stronger recovery in economic activity. As I said earlier, in the next kind of 6 to 9 months, I think we're going to need to see that interest rates or start to come down. Central banks have confidence that the challenge of inflation is over. I would expect that we've reached that point by, as I say, the summer next year, and then in the second half of next year we can look forward to some relief in terms of lower interest rates. But I think we need to be a bit humble here and also recognise that that's a very fluid estimate. You know, inflation has proved stickier than what many economists have predicted, and we have to be a bit humble and accept that that could still be the case next year. Nevertheless, you know, interest rate cuts are coming at some point in the next 12 months. Will be my best guess on this, and the reason for that is that we are seeing that, you know, at current levels, even if they hike today, monetary policy is still too tight for the economy it's too tight for an inflation target that's reaching 2% sustainably over the longer term. So why don't I stop there and now pass over to Lucy.
Thank you very much, Dean. Good morning, everyone. I'm Lucy Cole, and I'm part of BDO's Consumer Strategy and CDD team. So I'm going to be following on from a little bit of what Dean was mentioning about consumer spending habits, and I'm going to share some insights with you today from our seasonal consumer trends survey. Now, this is a survey that we run regularly with 1,000 consumers. We look at their spend intention, their past spend, their spending habits, and we can use this data to support brands and private equity to unlock which categories are looking more resilient in the market, where we think pockets of value are, and how brands can adjust their offering to capture changing trends. If I could have the next slide, please, Caroline. So just to start off with a bit of context to follow on from what Laura was saying and Dean, we've got very stubborn inflation rates, repeated media coverage about consumers pulling back on their spend, but we wanted to get a really honest view of this. So we have created something new for this season survey, which is BDO's discretionary dial, which is very exciting. And it's just a very good pulse on whether consumers have appetite for a discretionary purchase. So the way that this works is we ask consumers to name a sum that they would be willing to pay for a long weekend of their choice, all included. We then say, could you make this payment in the next 7 days? And the good news is 3/4 have said yes. So from this, we can establish not only do consumers have savings put aside, but they're willing to delve into them for a non-essential purchase. Could I have the next slide, please, Caroline? So we're now going to look at consumers' spend intention. And in our seasonal survey, we review all of these categories, which you can see along the x-axis. So there are 3 lines here, which are our survey results over time. The dark blue line at the top being the most recent. And as you can see from this, across the board, spend intention is now the highest that it's been all year, which is very encouraging. On the left-hand side, you'll see a rise in spend intention. And we can see that these are the essential categories. So includes things like mortgages, but also more essential retail items such as pet and baby care, where consumers are less willing to cut back. There's a little bit of a slither in the middle there, which you can see around holidays and entertainment, which are discretionary, but still very much prioritised spend areas at the moment. In particular, holidays is a bit of a boom going on there post-pandemic, and entertainment, partially around consumers more willing perhaps to spend some time at home post-pandemic and cutting back on leisure. This is having a good moment as well. So the chunk in the middle in pink that you can see, this is largely non-essential retail categories, and we're going to be talking about those in more detail. But what you can really see is that finally sentiment is actually positive across all of these sectors, which means that consumers are looking to increase their rate of spend there. And comparatively, you can see retail coming out more strongly than leisure activities. So consumers more willing to cut back on going out than they are on purchasing their products. Thank you, Caroline. Just to take a brief closer look at these retail sectors and the uplift that we're seeing. Now, pet care, as we've mentioned, one of the essential categories, so that's coming out on top. Very high spend intention of plus 16%. Similarly, baby care in second place is plus 8%. And this is a narrative that we've seen quite consistently across all of our surveys with these essential areas in the market. However, it is good news that these categories on the right-hand side, which you can see, these are the ones that have been struggling the most, but these are the ones which are now seeing the biggest uplift in the most recent survey. So things like electricals and big ticket spend items. Can I have the next slide, please? So when we take a look at this by age, what we can see is there is a really big disparity between spending rates of older and younger consumers. So Gen Z in particular, we've talked about them a lot recently, you may have seen about them more in the media, they're continuing to uplift their rate of spend. And in particular from our survey, we can see that this is on the more discretionary areas. So namely beauty and apparel, really strong uplift here. And the reasons for their behaviour, we believe this is related to an increased chance of living at home with their parents now. We've seen a big uplift in this over the last sort of 10, 15 years, more young adults living at home with their parents. They're more protected from price rises in areas like mortgages and utilities, groceries as a result. So as a result, feeling more carefree, able to go out and treat themselves. And this should be a focus for brands in these discretionary categories. In contrast, we've got Grey Pound at the other end, so over 65-year-olds, and they are actively cutting back still on everything except for pet, this more essential area. And then in the middle, we've got what appears to be the strongest area of spend sentiment with this middle age group category, but actually they're really over-indexing on the essential categories of pet and baby care, which is indicative of their stage of life, of course. May I have the next slide, please? So as Dean mentioned, while sentiment across these retail sectors is looking positive, but it is tempered by the fact that we are in an inflationary environment, of course. So we do have to consider to what extent price hikes are contributing to this increased spend intention. And so we ask consumers why it is that they are spending more. And across all categories, we can see anticipated price rises are named as a large contributing factor. However, there are some other reasons which stand out. So the first one, sustainable products. This is primarily something that we're seeing in younger consumers, notably beauty and baby care. Secondly, sports subscriptions, an area that's looking quite strong at the moment. From this, we can garner that consumer appetite is becoming more active, consumers show more interest in health, and as a result, they're willing to show loyalty to sports brands in order to get those discounts. And the third point that I will draw your attention to is this more premium product area, particularly and unsurprisingly, higher earners are over-indexing here on switching to more premium products. So this luxury end of the market is looking more resilient at the moment, especially in apparel and in beauty. So if we just move on to the next slide. We're going to have a look finally just at how best you might be able to capture these customers. So we ask consumers for their preferred methods for researching and purchasing products. Now, interestingly, nearly all consumers named online shopping as one of their preferred methods. That's that red line that you can see at the top there. And this is really prevalent across all age groups. In contrast, in-store shopping, there's a definite bit of correlation here between age and preference for in-store shopping. So we think that older consumers are looking to go more in store than they are online, which makes sense. And then we've got the inverse correlation for mobile shopping and social media, unsurprisingly. These remain the two least popular methods overall, but there is a growing prevalence among young consumers. And this is really good news for brands who will be able to access more customer data through things like using mobile apps, and also to be able to push more social media marketing, which is very effective with younger age groups and perhaps more cost effective than other methods of marketing. So to conclude, what does this data mean? We believe that brands need to make sure that they're using this customer insights to understand exactly what it is that their demographics want, and which channels will most effectively capture them. This is just some very high level information today, but if you would like to know more, or if you're looking for support in growing your customer base or any other business strategy, please do get in touch. And I'm now going to pass over to Neil.
Thank you, Lucy. Lots of good insight there, and thank you to Dean and Laura. So just before we get the panel together for the Q&A, some thoughts from me. So some mixed messages, I think, coming through, but there is some good news there. Consumer confidence and the resilience in the economy is certainly better than we expected around about this time last year. But I think it's fair to say retailers are yet to breathe that sigh of relief. And from a tax perspective, it'll be interesting to see what comes in the autumn statement. I agree with what Dean has said. I think fiscal stimulus through that statement is unlikely, but I think the government equally needs to be careful not to add further cost pressures to retailers with any new policies. So watch this space, and we'll report back on that later in the autumn. The other good news is employment is still solid. Retailers, as always, have been remarkably resilient through all the challenges they've had to navigate. And I think my assessment is similar to Laura's, that I'm cautiously positive for Christmas 23, and particularly if interest rates are held or maybe start to fall before the end of the year. But again, we'll have to wait and see. On the flip side, we've heard a lot today about the ongoing headwinds, particularly in inflation, the level of interest rates, and the ongoing geopolitical uncertainty. Over the last 12, 18 months, real household disposable income, certainly for the majority, has definitely fallen. But as we heard from Lucy, I think there's a bit of a key differential, almost a polarization between certain household groups. There's definitely a minority there, if they're living at home or haven't got mortgages to service, that are reasonably financially immune, but certainly the large majority are definitely feeling squeezed or financially distressed. And that means that certainly at that top end, where the consumer is more immune, there isn't really an impact on pricing or consumer behaviour, but certainly those in the middle are trading down. Those at the bottom are definitely cutting back and focusing on what's essential to them. So if we try and pull all that together, what does that mean for retailers, and what can they do to prepare for the golden quarter? And I think it starts, in my view, it starts with having empathetic and authentic communication with their customer. I think they've got to be careful to match the mood of the nation. And most importantly, they've got to build trust with the consumer. In terms of preparation, I think they've got to make sure commercial and operational infrastructure is properly aligned so that they can deliver on the promises they make to consumers. And I think that means ensuring fulfillment capabilities are robust, well planned. I think we've got to be very savvy about prioritizing profitable product categories and support that with accurate stock management. As we know from the past few years, the position on returns is massive in that post-Christmas period. So retailers have got to be ready for that, both in terms of volume and value, and maybe think about some creative ways of trying to monetize the effort they put into those categories. You know, is it going to be a flat charge for all returns? Or are you going to offer something like a free return service if you return product to store? And I think in terms of consumer behavior, one thing retailers can do is maybe think about that convenience a bit more closely. So click and collect locations, do they offer the convenience that consumers are looking for? Are they in the right place? Are they efficient? Have you got logistics providers that you can rely on and really deliver what you need them to? I think in terms of that polarization or differential between the different consumer groups, value for money and certainly value brand positioning, where that's possible, is definitely going to be in play over this golden quarter, and in particular to focus on those who are cutting back or trading down. But that said, I think there's going to be a piece around focusing in on what I'm going to term leveraging smart indulgence. I think consumers across all categories through the Christmas period will still want to treat themselves this period, but it's not going to be at any cost. So that comes back to Lucy's comment around data-driven personalisation. I think retailers have definitely got to use data effectively to ensure the right offers on the right products are going to the right customers. So hopefully that's given you a few thoughts, and I think I'm going to hand back now to Laura, who's going to compare a Q&A.
Thanks, Neil. And again, in the audience, any questions that you've got with the panelists today, please do post them in the Q&A function, and I will pick those up and manage those to pose that to the audience. I suppose, Dean, starting with you just briefly and sort of picking up on some of that sentiment. I guess as people are planning for maybe a similar year to this year, which, as we said, has not been that bad. It's been slow growth, and certainly I think a lot of retailers have started to see some of the easing of the very inflated costs that they had. But as Neil said, we do have some challenges that we'll see as we go through the autumn statement, particularly around rates, which I know we're specifically lobbying at the moment. But other things for people to be aware of, particularly around Forex. You know, it's quite interesting. We did our international podcast, and definitely our European colleagues, US colleagues, were perhaps slightly more optimistic than we've been, just because we felt that inflationary pressure, maybe slightly more here in the UK. But in terms of any thoughts people should just have as we stand back, because the majority of our audience will either export products outside of the UK or certainly import, particularly from China. So any thoughts that you've got, putting you slightly on the spot, around sort of Forex and what people should think about?
Yeah, so look, this morning the pound is trading quite low against the US dollar, and you know, for the UK economy, there are two currencies that matter. Our biggest export partner is Europe, so the euro matters. But the problem is, you know, it's not that simple, because a lot of international trade is still priced in dollars. Now, when I'm looking at the various crosses, you know, if, euro sterling. Sorry, in FX markets we always quote it the other way, but you know, it's traded at 0.86, which I think is about 114 in normal terms. But I would expect that, you know, kind of euro sterling exchange rate would pretty much track the current levels that we're at. And in fact, you know, we've actually, against the euro, we've actually been in a trading range since Brexit, by and large, trading between 0.85 and 0.9. I don't see a catalyst for that to change. If you think about it, a lot of the issues I described to you earlier that are facing the UK economy are facing the Eurozone economy, so it's pretty much for muchness. Where I do see some potential for sterling to recover is against the US dollar, but that's principally a weaker US dollar story. The US dollar is an easy currency to hold for international investors, especially in times of uncertainty. But I would expect that as that period of uncertainty fades, you know, you start to see investors start to diversify away from the US dollar, and that will support currencies like the sterling and the euro. So I could see them both higher, you know, in 12 months against current levels. You know, for what it's worth, can we go above 130? Probably. I think that's a reasonable estimate. But I think, you know, it's a story more for the later half of next year when confidence recovers a bit.
I suppose picking that up and passing to you, Neil, we've had a general sentiment over the last couple of years, because of some of the Forex exposure and some of the shocks that we've seen to onshore. You know, it's been disappointing in some ways that we've seen such a drift away from UK manufacturing being so prevalent into the retail industry, and there's definitely been a point of onshore. Do you think that there's anything that encourages people funds within the UK? I know I can see the face. He's putting another difficult question out here to me, but Dean's done it, so so just in terms of, do you think...
I was struggling to hear the question there, Laura. Sorry, you were cutting in and out.
Oh, sorry, can you hear me now?
Yeah, perfect, loud and clear.
Perfect. So I was just saying, Neil, as we take Dean's point around Forex, it's only going to push people to think again about import from overseas. So this onshoring that we've seen for the last couple of years, or this trend where people have more optimistically thought about sourcing within the UK, which certainly is a positive impact, and one that we saw drift for a number of years away from our UK retail industry. Do you think that the government will do anything in the autumn statement to help encourage that? Or do you think that it's going to be a fairly benign autumn statement?
My personal view is that's definitely on my wish list, along with reductions in headline rates and help for business rates, which have been long trailed. But I actually think this year's autumn statement will be a bit of a damp squib. I don't think the government has got a huge amount of room for manoeuvre, and equally on the other side of things, I don't think they want to tinker around with new policies that could have an adverse impact in the run-up to an election. So I think this year it will probably be pretty quiet. Towards the end of next year, it may be slightly different. I think what retailers and in fact most businesses in the UK really want is certainty and actually some sensible policies that are going to be there for the long term, so they can plan accordingly, work out what reliefs they're going to get for investment spend, etc., and know with certainty that if they fall within certain categories, they're going to get the reliefs that are due. And I think over the last 5, 6, 7 years, there's definitely been too much tinkering around the edges and not enough long-term thought about what businesses really need.
Great, thanks, Neil. And I suppose, Lucy, going to you, and again, following that theme of certainty, the last 12 months has been a real battle to gain the customer audience. We have that surge to online, very much a play to social media, and actually over the last 12 months, the cost of customer acquisition has gone through the roof as people have had to really fight with that as a channel. So if we take your customer sentiment around people's appetite to mobile purchase and purchase through social media, which I think if we'd probably done that in 21, the stats would have been really different. Did anything come out of the sentiment that sort of shows a couple of hints and tips for the audience of how people could perhaps do anything differently? Any of the sort of survey that gave a couple of gems, picking up on Neil's point, because it feels again that you're battling with a consumer that could change their habits, which they definitely keep everybody guessing, which is part of the challenge.
It's a really good point. I mean, I think we've definitely seen through our surveys, but also our project work and another analysis and reports that we've read, there has been this more permanent shift in channels that consumers have taken, which has been a result of the pandemic and now of the economic climate, which is pre-pandemic, there was a lot more in-store shopping. Now it's really shifted to these mobile channels, social media, and shopping online, because there's opportunity for price comparison. That's one of the key reasons, but also there are a lot more discounts often available on mobile apps through loyalty schemes and online tracking, because brands like to use these methods of collecting the customer data. It's really valuable for them to realize how their consumers are shopping, what the areas is that they're spending on, and tracking this data over time is incredibly valuable for companies. So for them, the incentivization is there to offer a loyalty scheme through a mobile app, through a social media channel, and then at the same time consumers are switching to that because they're willing to input their data and download an app in order to get more discounts. So it's really going both ways, but you're right that the shift is looking like it's going to be more of a long-term shift in behaviors essentially, and brands have got to keep up with that in order to capture this new type of customer and this new behavior.
Amazing. And I think we've always touched on sort of experiential retail, big theme that we've seen coming over a period of time, and I'm sure we'll touch on that on our forecast reports as it will, I'm sure, be a repeating theme. But picking up some of the themes of this morning and the fact that people perhaps are looking for a bargain, perhaps are looking for a discount, and that they have started to go back into retail. James, that the headlines on Wilko we've got to touch on in the collapse of what was a well-known discount player in the market in some ways. You would have expected them to fare okay, but certainly no rescue package was there for Wilko this time. Your thoughts on that and the headlines we've seen over the last few months?
Thanks, Laura. Yeah, just a few kind of high-level thoughts on the Wilko situation. I mean, for people that operate in my world, in the restructuring world, was it a surprise that Wilko failed? Absolutely not. I think it was an accident waiting to happen. They built it up as a very expensive bricks and mortar high street operation, so it was very expensive to run in the context where government and councils don't really want you driving into the city centre anymore. So, going to buy anything of any volume out of Wilko in a city centre was becoming increasingly difficult. And I think that they'd lost their way. The others were doing it better. I mean, you had B&M, Home Bargains, mainly out of town, easy to park. Wander around any of their stores, they're very similar in the way that they set it up. You'll get your food at the start and then you go around to the pet bit, etc., etc. So it was a very familiar shopping experience. So no great surprise that this has happened. My biggest surprise was that anybody was actually wanting to buy it as a whole. And again, when they did their limited diligence that administrative allowed them to do, they were clearly frightened off by the sheer cost of re-gearing the whole Wilko package. So again, that did not surprise me that fell apart. So we ended up with pretty much what people in my world would expect: a kind of break up the range of taking the brand. They'll take that in house. They'll keep the Wilko name, but I think they'll be very selective in terms of what they put in there. It will be complementary to the range brand. And then we've got the slightly, not odd, but Poundland and B&M buying up some stores. I think there's a wee bit of misnomer there in the sense that everybody says they've bought the stores. I haven't seen the detail, but having been involved in administration sales many times, that they will have taken a license to occupy in a lot of these stores. So it's almost buy to try. So I suspect they'll be spending time looking at what the store can do, renegotiating with the landlord, and I would be astonished in a year's time if the numbers that I've talked about are still all there. So a sad end for an iconic brand, but as I say, no surprise in terms of what's happened and no surprise in terms of the outcome.
Yeah, and I think plays to the fact that there's people that are winning and people that are losing it, and that I don't think we're expecting to happen. And I know there's headlines this morning on Body Shop and the bidders for that. So just conscious of time, just a final word from each of my panelists as we go in. We are going into the golden quarter. Look, we look forward to discussing, debating, unpicking that trading, particularly what we see from Amazon this year as we go through the next few months. But a couple of words from each of my panelists around just some final thoughts. So Neil, starting with you.
I think going back to what I said earlier, I think in my view, it's all about building trust with your consumer. And I think you can do that in a number of different ways. I think data personalization has a big part to play in it, getting the right things in the right place at the right time, and actually delivering what you promise. So making sure your logistics and all those people who are supporting you, particularly in that last mile, are trustworthy, reliable, and do what they say they're going to do. Thank
you, Neil. James?
I would say as we're moving into the golden quarter, look after your cash. I think, all the situations that we see and advise on, if people have got some kind of cash buffer with them, then there's options that you can look at. So, be very much on top of your cash, talk to your lenders, and make sure your liquidity is as strong as it can be, because it's still very uncertain times. We just don't know what other hurdles may be in front of us. So that would be my biggest tip.
Lucy?
Following on nicely from Neil's point, I would say really understanding your customer, understanding how they're shopping, what they want, and how you can best capture that in the right channels, because you'll need that to maintain your customer base and also to grow it over the coming months.
And Dean, any thoughts from you?
Yeah, I would say that high interest rates are here perhaps for a little bit longer than what we're expecting. but don't buy the doom and gloom story. Consumers, households and firms have proved far more resilient to higher interest rates than anybody predicted, and I see no reason that's going to change.
Thank you, Dean. Definitely covers off James's slightly doom and gloom. Well, we won't invite him again. We'll definitely invite you. So with that, Dean, a particular thank you from me, but thank you to the rest of my panelists. And guys, have a great rolling quarter. We look forward to seeing you in January with our retail trading update. Have a great day.